Hi, welcome to Family Wealth Planning Partners. I'm Brian Ramsey, and this is week 5 of a 5-part series we started on the different account types that are available. Now, if you go back and look, week 1 we discussed pre-tax versus post-tax investing. Week 2 we looked at pre-tax investing, but more along the lines of what account types are available for pre-tax investing. Week 3 was examining post-tax investing in the accounts that are available. And then week 4 we looked at, if we're going to allocate $1, what is the most effective account type to start allocating investment dollars? This week we're going to look at the taxation, or their overall taxation of each of these accounts. And you might ask yourself, if you watch the 5-part series, is why are you guys so interested, or why have you guys harped so much on the account type when we've always been told that the most important thing to consider when investing is the mutual fund or the exchange traded fund that's in each of those accounts? And I will tell you that yes, investing in the proper mutual fund or exchange traded funds or individual stocks or bonds, that's incredibly important. However, and also I'll say that that's mainly what you hear if you watch TV or on the radio is, oh, just put 15% of your pay yourself first and put the first 15% of your paycheck into a large cap growth mutual fund. And that's okay, and there's nothing wrong with that, and we actually encourage that. But at some point, you have to consider the impact of those decisions years and years down the road. Now, we go through a series on how to actually invest and what you need to consider when you're investing $1, and that's another series that we've done. But today we're really talking about the account structure. We really feel that the first step in your investing process is to understand the different account types that are available and the impact of you not only investing in that $1 today, so how it affects you today from a tax standpoint, but also how it affects you over the course of time, and then how that investment affects you from a distribution mode. We find that lots of clients come in, and this is the one aspect that they've overlooked, is the impact or the importance of the account type. So today what we want to do is just kind of quickly walk through each of the 5 steps or the 5 segments of account types. Now, we did look at pre-tax versus post-tax, and that's good, but really we're looking at the taxation of each of the accounts because they're all a little bit different. So what I'm going to walk through is 3 different phases. It's initial contribution, how that's treated from a tax perspective, the ongoing investment structure, and then the last thing I'm going to name is the distribution. So for example, the first segment we're going to look at is pre-tax, tax-deferred, tax-free. Now, what I mean by that is pre-tax meaning you put dollars into this investment before you're taxed in your paycheck. Tax-deferred meaning that while that money's invested, you don't pay capital gains or in taxes on the income or the dividends that you receive in that investment structure or that investment account. And the last is the distribution. So whether it's taxable on the way out or tax-free and that sort of thing. Now, keep in mind that as we walk through this, some of these accounts, especially like an IRA, for example, can be in multiple locations. Okay, so it can be pre-tax or post-tax. It can actually be tax-free or taxable. So we'll have to, and hopefully I'll mention that, but just in case I don't, just keep in mind that some of these account types can actually be in multiple segments here. So the first one we're going to look at is pre-tax, tax-deferred, tax-free. And the only account that I'm really aware of is the HSA, Health Savings Account. If there's another one out there, by all means let me know. But that's really the only account type that I'm aware of that has that account structure. The second one is pre-tax, tax-deferred, taxable. And that's where most people think of 401ks, 403bs, 401ks, 403bs, IRAs would fit into this category. That just means that, again, you're going in pre-tax, the investments are tax deferred, and then on the way out it's taxable. Now, one caveat here is that as people invest money over the course of time, when we get into the distribution mode, whatever tax or whatever withdrawals you make out of a IRA, or if you leave your money in your 401k, most people roll it into an IRA. So let's just use that as an example. We have, the majority of clients wind up paying some sort of tax on that, but that's taxed on as though you received income that year. So it's based on whatever your tax rate is that particular year. We also have clients that just don't make enough money for it to be taxable. So we would say that's tax-free. That's not too many clients, but there is that scenario where that is the case. So the third one is, now we're getting into post-tax. So post-tax, tax-deferred, tax-free. Post-tax meaning now you've been paid and you have money in your checking account and you're investing into an account type, and that's post-tax. So post-tax, tax-deferred, tax-free. We're going to say that is the Roth IRA and the College 529 plan. That is that is one of those account types that sometimes can be underutilized for what it is, and that is post-tax, tax-deferred, tax-free savings. And so we walk clients through that. Hey, here's the 529 plan. Here's how you typically use it, but here's how you can take advantage of that account type for long-term investing. And we walk clients through that. So if you've got questions on the 529, let us know. We also have a series on 529 investing as well. In this same category, we're going to put in there cash value life insurance. Now, I'll put a disclaimer at the end of this one too, but cash value life insurance is really not, it is sort of an account type where you're putting after-tax dollars in. For the most part, there could be scenarios where you do it on a pre-tax basis, but for the most part, typically what we see is clients investing in permanent life insurance on an after-tax basis. The growth is tax-deferred, and then the distributions are tax-free. Now, that's not in every single case, but for the most part, if a client has cash value life insurance, that's the way we structure it, is for tax-free withdrawals. We do have a whole series on life insurance, specifically whole life insurance and how we use it. Very, very rare that we even have a client that owns whole life insurance or permanent insurance that accumulates cash value, but those that do, there's a specific investment strategy around it, or they come to us with it and we're just using it for what it is. So we would throw the cash value life insurance in that mix. Then we have post-tax, tax-deferred, taxable. We're going to put potentially IRAs and annuities in that. Now, let me say this, that again, IRAs and annuities, and we're going to throw annuities in there just because they're sort of popular, I guess. We're going to say that those two account types can be pre-tax or post-tax. We just chose to put them in the post-tax just at the end of the conversation, more so than anything else. But again, IRAs can be contributed on an after-tax basis. They grow tax-deferred, and then when you take withdrawals, they're going to be taxable based on your tax rate at the year of distribution. Annuities, again, we would say this is an investment within an account type, but we find that a lot of folks think annuities is an account type. So we'll just throw that in there just for conversation piece. But keep in mind, annuities can be invested on a pre-tax basis or a post-tax basis, but they're treated the same. Tax-deferred growth along the way, and the distributions are taxable, unless it's a Roth IRA. And again, we're talking generally speaking, that's how they're taxed. So that's it. That's the 5 levels of investing. And now, again, I want you to keep in mind that the reason we talk about the account types is because we think it's incredibly important to understand not only the investment, how it's treated up front when you initially invest, but it's also incredibly important to understand the impact to you over time and at the point of distribution. So we would say that, when clients come to us and, they initially meet with us, they want to know about, how do I invest and what, Do I use exchange traded funds or mutual funds or individual stocks or individual bonds? And all that's important. But we would say that the most important thing is to understand the account type we're going to utilize to invest their assets. That's sort of step one. And we often find that that is an overlooked process, is to walk through that, to understand where's the best place to allocate dollars so that we get the full advantage of tax breaks up front, but we also understand and know the tax impact to you later on in life when you get into distribution mode. So again, this is the end of a 5-week series. Hopefully it's been helpful. We hope that you've gathered a little bit of information, and hopefully you can use this information when you're doing your research to determine how to allocate your investment dollars and what's the best account type to do that in. And if you've got any questions for us, please feel free to give us a call. You can email us. You can schedule a one-on-one meeting with us if you want. You can register for our blog series to get all the different, our weekly blogs, or you can visit our website. In the blog series, they're labeled in order they are produced and by category. So anyway, thanks for watching. We hope you received some nugget of information you can use out of this series. And again, let us know if there's a series you want us to produce. We have clients that say, hey, I'd like to get more information on this particular topic, and we're happy to do that as well. So thanks for watching, and have a great day.